Welcome to TheoTrade. This is Don Kaufman. It's April 1st, 2019, beginning of the second quarter, and you are watching the TheoTrade evening video. Well, I got to tell you, this is, for the most part, precisely what we discussed on this weekend's video, and that had everything to do not so much with the S&Ps per se exploding to the upside. That was to be expected, but that the bonds were firmly driving order flow effectively to this marketplace. Let's take you immediately to the bond market and take a look at what has happened to the bond market. People, that's about 1.5 points. Now, if you're not necessarily up to speed in reading bond ticks, which can throw a lot of people off a little bit here, but there are 32 ticks to a 1 point move. We've moved a point and 15 ticks. Effectively, what have we done? Well, we've moved just about 1.5 points to the downside inside of the bonds. Specifically in this weekend's video, I talked about, and I'll give you verbatim what we said, is the bonds are in a very, very precarious kind of stance right now after having this wicked rally up. We fully anticipated them to cruise right back down effectively to this 148. Now, at the exact same time that I said that, I also reiterated on the weekend video, I don't want to be short bonds. Why? I don't want to be short bonds because at this point in time, I'm actually I'm looking at this and thinking that the bonds are going to back off, and it's only going to be, like this momentary lapse of reason before they explode back to the upside. You have to look at this entire move inside of the bond. It's almost, if you will, like a crash to the upside. We kind of pull back and then explode higher from there. And that's the way this thing seems to be kind of shaping up from this point forward. Now, as we're coming close to the cash close here, again, just about 4 minutes left in the trading session, the S&Ps are up 35. Again, it's not about the S&Ps. It's about the bond market. So, as I said, the bond market explodes higher. The moment the bond market explodes higher, takes interest rates down. Interest rates coming down, what does it do? It smacks the XLF. The financials are getting rocked. And again, the XLF happens to be indicative of the financials, so the financials get rocked. Well, the financials last week try to pick up a little bit of steam to the upside. However, all the financials needed, was just a glimmer of hope. And that glimmer of hope came by ultimately these bonds backing off. The moment the bonds backed off, the financials ripped to the upside. And again, make no two ways about it. All right. It's the bonds that are ultimately driving trade into the financials. The financials then kind of reverberate and take us to where? Well, that effectively takes us right back into the S&Ps and drives the S&Ps higher. I mean, listen, if you're caught like in technology land, look how tech is performing today. Tech is the underperformer today in the market. This is the monsters of tech. What's the monsters of tech? Well, that's your kind of conglomerate symbol here of Microsoft and Apple and Facebook and Amazon and Google. They're actually underperforming. In fact, Apple during portions of the day was actually down on a percentage basis. The outperformer today, once again, it's the financials. One other thing that I talked about in this weekend's video was the odd kind of trade that was inside of the financials. And again, if you missed kind of the weekend video, you should definitely tune back into it. And I'm going to cover another aspect of that weekend video here momentarily. But if you take a look under option statistics, the volume that is trading inside of the financials, that's not just today. By the way, the sizzle index is 3. Effectively, what that means is there's 3 times the daily option volume versus the previous 5 days. Now, I also pointed out in this weekend's video that there was massive call buying, that was going on inside of the XLF. Now, people, it is very rare. I don't often look at option statistics and think to myself like, hey, this is odd, this is unusual. But inside of the XLF, the reason it stuck out so much is that, again, last Friday specifically, the call volume, it wasn't just unusual because the rest of the marketplace was utterly dead in terms of option volume. All the option volume that was being done in the marketplace, it was right here inside of the XLF. And today, again, some of that heavy volume kind of continues. But the interesting aspect of this is the volume today inside of the XLF. This seems to be people wiggling out of positions. I don't want to make that abundantly clear. Look at some of the volume that's trading today versus the open interest. I mean, these positions were being opened like last Friday, again, denoted by the open interest. And it sure looks like they are what I call whacking out of those positions in a hurry. Now, that is right there, it's 150,000 of those contracts that are trading, okay? And you can take a look at like option time and sales to your heart's extent. But listen, this, again, unusual volume is all being perpetuated by none other than, again, the bonds. All right, to continue with the XLF, and again, the XLF is going to be, okay, center stage. This is what you want to focus on the remainder of the week. Why? The implied volatility is starting to get rather heated in here. Now, we have a marketplace, again, minute to go left in the trading session. We have a marketplace that's exploding to the upside, right? At the exact same time the marketplace is exploding to the upside. You tell me why volatility, okay, isn't backing off inside of the financials. It clearly sees risk, and that risk is likely coming by way of the employment report. The employment report is probably going to rock these bonds as the bonds get rocked higher or lower, okay, later this week. And I'll give you my feelings on that here in just a minute. But as those bonds get rocked higher or lower, the XLF, okay, could actually benefit or get absolutely decimated. Now we're coming into the XLF, right up to this really critical level, once again, of 2650. Quite frankly, I didn't think we were going to see 2650 again for quite some time. But again, the XLF climbing above 2650 would be a very bullish indication for the overall marketplace. If this is not bullish enough, okay, however, we're still only up about 1% today. Believe me, if you're a little bit of a bear like I am, this thing could have been a lot worse to the upside. Nevertheless, much of this move, specifically today, there's the closing bell. Much of this move specifically today was really kind of well telegraphed over the last few days of trading session. And I really hope I tried to overemphasize that again in this weekend's video. Speaking of a little bit of volatility, check out this cash close. We just took off to the upside from the 70 level, exploded to 73, only to revert right back down, all in the last couple of moments of the trading session. All right. So we talked a little bit about the bond market. We talked a little bit about the XLF, right? Okay, let's actually look briefly at the S&Ps and what we can kind of expect, again, in some of the days to come. When I take a look at the S&Ps, we're trading out, again, between kind of gravity points. The upper gravity point here is 2911. This lower gravity point, 2842. Now, to discuss levels in the S&P futures, you can't do it justice without looking at the SPX. Why? Because what you need to know, and this is one of the most important points I think that I can make on a Monday here, we're just a stone's throw off the expected move already. Okay, listen, this entire week of trade, and I want to bring this right into scope here. This entire week of trade, right, had about a $37 expected move. Again, a $37 expected move in the entire week of trade. Now you're like, okay, great. So how far did we move today? Well, if you take a look at the S&Ps, okay, what were they up today? Roughly $32. So you're telling me, okay, that we got almost the entire expected move in one trading session. That's exactly what I'm telling you, okay? But what doesn't make a whole lot of sense is take a look at this Friday's expiration. There's still a $29 move being priced in. We almost have to kind of rethink about the terminology of volatility, because most of the time we associate volatility with a marketplace that's crashing to the downside. But now we actually have volatility that seems to be emerging even with the marketplace effectively moving up. The number one thing that I can tell you about this kind of volatility is you do not want to be a seller of option premium. If you sell options in here, you just got, okay, your chicken cooked literally overnight. Like the 1 week options, it's insane. The entire week's straddle was trading for $37. You could take a look at it. The entire week's straddle was trading for $37, not even $37, okay? Meanwhile, we moved more, okay, than what the straddle was basically trading for in one session. So again, it goes to show you that looking at things like implied volatility versus actual movement in the marketplace is well worth its kind of weight. So what do we anticipate for the remainder of the week? No question about it. We're very likely to come up here and touch the expected move, possibly cross through it. But to figure out what the rest of the week actually holds, you got to go back to the bond market. You really do. You have to go back to the bond market. The bond market. I'm going to tell you precisely what I would anticipate. What I'd anticipate, mild follow through to the downside inside of the bonds, followed by, again, later in the week, a rip back to the upside. As I said, I view this as almost like a crash in the markets, right? but to the upside. I think the better way maybe to denote this isn't necessarily looking at the bonds. I think the better way to denote this is looking at the interest rates themselves. The interest rates absolutely kind of crash down. Now what do? Like any marketplace that's tanking, that actually pops back up, only to see the marketplace get hit once again. Again, everything from politicians to, Fed governors are out there. They're talking about now, hey, we should be cutting interest rates. Larry Kudlow actually came out of the blue and even said we should cut 50 basis points. I think there's some politics behind that, but put that aside for a moment. With all these kind of calls for cuts of interest rates, again, you have to ask the question, is it politics, purely politics, or, is there an economic reasoning behind effectively some of this? Last but definitely not least, with all of this, and again, to kind of telegraph this, if the bonds are going to track back higher, it's going to put pressure to where? The S&Ps, but it's going to do it by means of the XLF. I'd actually look for the XLF, to continue possibly right to this 2650, then back off again kind of later in the week. Again, the employment report is really going to leave us on edge later in the week. Two other stocks that I want to show you were in play that I was using as defensive position. One of them happened to be Starbucks. I have a short position inside of Starbucks. The irony is, and this is exactly what we expected, if the marketplace continued to the upside, Starbucks would start to back off. Again, this is being used for some reason as a defensive play. Right? I'll talk about that more tomorrow in the TheoTrade chat room. Another one that we're actually using for a defensive play happens to be none other than the utility sector. So if I zoom in this, another short position we happen to have on is the utility sector, which has absolutely started to back off. Here's one where I think is still open for those of you that are looking for a trade, but this is going to be a duration play. It's a duration play, and that is an expectation of downward movement inside of the XLU, on a period greater than 3 months. With that, I want to thank everybody for joining us this evening here on TheoTrade. Have a wonderful evening. Bye-bye.